Hi everyone, this is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I love to have him on every couple months. I always enjoy my discussions with him. He is former Wall Street bond trader. He's a gold fund manager, and he also runs the popular, rapidly growing investment research Dynamics website, also the great new podcast. Thank you Shadow of Truth with Rory Hall. Thank you for joining me, Dave Kranzler, again.
Thanks for having me. I always enjoy being on here and chatting with you, Jason.
Yeah, I enjoy your discussions a lot too, especially since you're a reformed Wall Streeter now. there's not too many of those out there. Most of them are getting too rich off the gravy train.
Yep, that's true. It was probably my mistake to leave New York and move out to Denver in 2000.
I think Denver's a nice city. I think you have nice restaurants out there. It's probably a nicer standard of living in terms of quality air and organic food. And I think they just legalized marijuana, although I don't know if you partake in that. But there's opportunities there besides just trading bonds on Wall Street.
Yeah, no, that's true. The lifestyle is definitely a lot more comfortable than New York can be. That's for sure.
Do you go skiing or snowboarding in the winter?
I ski, yeah.
Yeah, I used to do that when I was younger, but my knees are pretty bad now. I'm not sure that's a good idea for me to do that too often anymore. Okay, well let's actually let's talk about markets here. Rather, we could talk about this when we're not recording. I want to ask you about Greece. You've said some very interesting comments about Greece. Do you think Greece is being sacrificed right now by the ECB and the large Wall Street investment banks like Lehman Brothers was?
Well, that's a good question. I mean, what I can't figure out with the whole situation is why either side is still at the negotiating table. I mean, in my opinion, I think the Troika side of the table is a lot more interested in maintaining the conversations than the Greece side. I mean, quite frankly, if I were Greece, I would just revert to the drachma and start printing the daylights out of it and paying off all their debts in printed drachma. That's what I would do. I mean, I don't know, I almost never agree with Martin Armstrong, but he wrote an article about that yesterday where he basically said the same thing. I've been saying that for quite some time now. So to me, there's something going on beneath the surface that requires that it's in the ECB's best interest that they negotiate some sort of kick the can down the road deal with Greece. And I think it has to do with the fact that if they were to write down the Greek debts, the ECB would render itself technically insolvent. And I think it also has to do with OTC derivatives, primarily in the form of credit default swaps. And I think if Greece were to be declared an event of default, which they haven't made their debt payment. I mean, I thought they had a big debt payment due June 30th. I mean, isn't that by definition default? So
it is, but when you have very
when
you have very expensive lawyers involved, right? When you have very expensive lawyers involved, what's reality? They can change it around with legalese, right?
Well, I don't even care about that. It's for derivatives purposes. An event of default hasn't been declared, and so I just have a gut feeling that there's a serious disaster sitting beneath the surface on bank balance sheets, and that includes U.S. bank balance sheets. I mean, let's not make any mistake about this. I think the U.S. is there in the background on the Troika's side with a lot of influence.
Yeah, I know Mark Faber expects contagion and there to be counterparty risk and other things, but they might figure out a way. With the reason I brought up the lawyers is, these guys are very expensive lawyers. They're spending a lot of time on this. They might figure out a way where it's really a default, but they figure out a way where it's not really a default, where there's some, extra backdoor currency swap that the market's not told about, or someone else gets a secret bailout or handshake or something else. I mean, so those credit default swaps don't trigger, because rationally the credit default swaps should trigger. There's a whole bunch of hedge funds that have bet on them triggering, right? But the rules, it seems to me, the governments, the people in power, whether it's U.S., ECB, they're good at changing the rules. They're good at moving the goalposts, and we'll probably see that here. So the hedge funds that tried to front-run Greece defaulting, they may not make out and get rich like Kyle Bass or some of the others did in the past.
Yeah, and all that stuff is, again, behind-the-scenes stuff that we, again, to me, the basic storyline is, why is the Troika still at the negotiating table? They have some sort of hidden motivated interest for being there. And so I'm just suggesting that it has to do with primarily the derivatives problem.
Yeah, I agree. It's all about the derivatives market, considering how large the derivatives market is. But if Greece does leave the euro, like you said, and starts printing the drachma, if I'm a Greek citizen, I hope I've already gotten a whole bunch of physical metal, maybe a little bit of Bitcoin for liquidity purposes, maybe temporary, at least for a temporary, and maybe even some U.S. dollars just for temporary liquidity. Almost anything would be better than holding drachmas then if they do leave the euro and start printing like crazy, because then they're going to rapidly devalue, right? Maybe a potential hyperinflation then?
Well, that would probably be the only reason that Greece isn't reverting to that solution. But I also think that China and Russia are standing in the background, ready to help them out. So,
yeah, that makes sense that China and Russia would be wanting to help them out. Speaking of China, we've now seen. I saw on Jim Rickards' Twitter feed, and we're also seeing other reports of this, that the Chinese government, it looks like they're now printing up RMB to buy stocks to try to prevent their general stock market, the Shanghai Composite, I guess, from crashing. And I also saw on Zero Hedge that they had a story that the Chinese government has banned most of their media from putting out any negative, bearish, either exposés or news segments on the potential stock market crash.
Do you think that's any different than what the U.S. government's doing right now?
No, it's more overt.
Our Fed's been printing. I don't know. I don't think you can get about any more overt than happened today when the S&P was down 20 after the open, and it closes up 12. I can guarantee you that was the Federal Reserve in there buying stocks through its proxy agents, the banks and some of the hedge funds. And
yeah,
in terms of publishing or broadcasting negative news about the stock market, I don't think I've ever seen anyone get on CNBC or Bloomberg News and talk negatively about the stock market. There was someone on CNBC today, some senior money manager or professional guy who supposedly, who said, "Oh, I think stocks are very fairly valued right now." I mean, anyone who's an educated person who gets on financial media and makes the statement that stocks are fairly valued right now is a complete idiot or completely corrupt. I mean, the U.S. stock market, by just about any metric you want to use, is the most overvalued that it's been in history, and that's especially true if you adjust the GAAP accounting that's currently used and apply GAAP accounting standards that were used, say, in 1990. And then by then, every single metric that you could possibly think of is showing us that the stock market is more overvalued than at any time in the history of the world. So, honestly, I mean, who cares if China's printing money, and buying stocks? It's not like the U.S. is doing anything any differently.
Yeah, I agree. And it's not just the U.S. and China. I mean, Japan,
right.
The Bank of Japan is printing. They're buying. They already admitted in public they're buying stock market indices. They're buying up all the Japanese government bonds because there's no real demand for Japanese government bonds anymore from pension funds and many individual Japanese people. So they're the buyer of last resort. We got that in Japan. We got the U.S. government. They're doing everything it takes to do financial repression and keep interest rates down and buy up the treasuries either one way or another, whether it's Belgium or the Caribbean or, whoever. And I guess they're propping up stocks too. I mean, the technicals, I think, Dave, I've really started paying attention to markets 2007, 2008 when I started to learn, and then I worked in the financial industry. After 2008 and 2009, I think the rules changed. I think the people, were caught off guard by the Lehman collapse or whether or not they allowed it. I guess it was a sacrificial lamb. But every other year since then, it seems, when the technicals are bad in the general stock market index, someone comes in, like you said, at the end of a close to prevent the technicals from turning super bearish and comes in and buys the dip like crazy, either with S&P 500 futures or something along those lines, or a QE program announcement or something, and they turn the tides on the tape.
Well, this is how it works. The Fed will go in and the New York Fed has access to HFT pipelines. And And so what they do is they stick a bid in there into one of the slower pipelines for, say, 100 million worth of S&P E-minis. Well, the other HFT pipelines see that, and hedge funds front-run it. And that's all they need to do to juice the market. I mean, it's all robotically controlled with computers. I mean, this morning when the S&P was down 20 points and it looked like the stock market was going to completely fall out of bed, the housing stock index that I look at, the Dow Jones Home Construction Index, was actually green. And you want to know why? Because the 10-year Treasury bond had dropped almost 10 basis points in yield. And that's the hedge fund program saying, oh, yields go down, I got to buy housing stocks. And it's just automatic.
Yeah, and the homeowners, like, they're beating earnings, but aren't they talking the bar down, though? I know there was a beat in the last, like, couple weeks or something like that, at least for one of the major ones, but I think what they did is they gamed the analysts that were covering the stock. They talked the bar. They spent, the last month or two talking the revenue projections and the earnings projections down so they could beat by a penny or two and then say, hey, look, we beat.
The home when it was really, gaming their earnings using accounting gimmicks, and I have some research reports on my website that go in depth into some of the primary accounting gimmicks they're using. And some of these big home builders, they'll have, a couple billion in debt on their balance sheet. And then if you look at the income statement, there's no line item for interest expense. It's because they're capitalizing. They expense some of the interest expense in cost of sales, but then they capitalize the rest of that interest expense. So, and that basically, for GAAP purposes, pulls a big expense of theirs off their income statement, and it helps goose their bottom line. But there's plenty of other gimmicks that they use also. So
that's the new normal. Welcome to Dystopia. I mean, so many of these large corporations do financial engineering. I'm actually a member of the finance group on LinkedIn. I don't know if you are, but they actually send me like an invitation once a month to a new financial engineering conference that I can go to in the United States, so I can learn how to do more accounting tricks and beat the numbers like that.
Yep.
It is what it is. It's the new normal, I guess. Welcome to Dystopia. Instead of real growth, right? We just come up with accounting gimmicks, with artificially cheap debt and artificially cheap interest rates and things like that to grow our stock price no matter what, so we can trigger our options and retire in 3 years instead of 10 or 20.
Exactly.
Now, Dave, since you worked on Wall Street, I've tried speaking with a lot of mainstream Wall Street people, money managers. I've spoken on Twitter with Mark Andreessen. He's the technology billionaire. He started companies. These guys won't admit that there's a lot of evidence of these asset prices going up, that's where the inflation has gone. And Ludwig von Mises and Murray Rothbard talked about decades ago when they wrote a lot of their works that a lot of the inflation, the money supply increasing, it wouldn't go into the regular economy first. It would go into the asset markets first. That's where they thought most of the time it would go. Why do you think the people on Wall Street, these money managers, hedge funds, why do you think most of them, either on or off the record, won't admit that that's where the inflation is going into the asset markets?
Well, because, if they were to come out and say that, then there would be no reason for them to do what they do, right? They're attributing their great returns to their skill as managers. And if they were to come out and say, oh, well, the only reason all this stuff's going up is because of all the money the Fed has printed, it would basically take away their whole reason for existing, right?
Yeah, exactly. I think there's actually a quote by Upton Sinclair, who's a communist, and, he did write The Jungle, but it was a fictional tale. And he actually said, don't expect a man to realize the truth when his salary depends on otherwise.
Exactly.
So,
well, just look at it this way. It's not just these guys. Have you ever heard Warren Buffett come out and say the stock market's overvalued? I think just recently he said the stock market was good value.
Normally he doesn't normally say that. He just says he's not buying right now, and he holds cash. So like in 1999, some of the other times where the market's been drastically overvalued, 1999, 2007, Buffett was normally not buying a lot of shares. He normally went to a lot of cash. So instead, you have to normally judge someone by what they do and not what they say, especially George Soros and Buffett and those types, because they're political and they can play games with the market, psychological games. So I think Buffett's actions speak volumes. Where if he's going to a lot of cash, it makes him think he can't find bargains and that the market's overvalued.
Right, but my point is, have you ever heard him get on CNBC and say the stock market's overvalued? I've never heard him say that.
Oh, I think he'd get a call from Obama maybe 10 minutes
there
later.
You go. So
that,
it's the same dynamic. I mean, none of these guys are going to admit the obvious, and they all know. They all know.
Yeah, I mean, a few of them off the record will admit it, but on the record on a podcast here, I almost had Jim O'Shaughnessy, the billionaire guy who invented the price to sales ratio on. I'm going to try to get him on later in the summer. And I don't think he's an Austrian school libertarian type. I'm going to try to see what he says about how overvalued the market is. We'll see if I can get that out of him. I know I can't get that out of like Barry Ritholtz and some of the other guys. I don't think they would admit that on the record. Okay, well, I want to move on to the next topic. You have an article about copper crashing and the oil price dropping. Do you think then that the real economy, the global economy, is drastically starting to slow down?
I think it has been. I think the price of oil is down over 50% since June of 2014. And I mean, it's been blamed on supply factors, but I think that's a bunch of BS. I mean, there's too many other metrics out there that you can use that show that global demand is just plunging. You know, the Baltic Dry Index being one of them, the Shanghai Container Freight Index being another one of them. Lumber had a big bounce over the last few months, but lumber has been plummeting. So yeah, I think oil and copper are two of the best bellwether indicators of relative economic activity, and when they're dropping, it means so is economic activity. And I think what happened when oil got down and almost broke 40 and then it bounced, and I think what happened there is I think we saw intervention in the market, and I think the Fed wanted to prop up the price of oil because a lot of these big banks are sitting on unsyndicated leveraged loans to the oil shale and fracking companies that they weren't able to sell down, and no one wants them now, of course. But at a certain price level, these companies can't make their interest payments, but at a certain price of oil, they can at least service the senior debt. And so I'm pretty certain that the bounce we saw in the price of oil was partially a technical dead cap bounce with hedge funds robotically chasing price momentum, but it was also, I'm sure the Fed was in there with its quote-unquote invisible hand helping keep the price propped up. I mean, if you look at what happened today, the price of oil was about ready to break 50, and miraculously it rallied. I think it closed 52 handle today or something like that.
Yeah, I think there is manipulation in the...
Essentially 52.90 basically is where it closed. But I mean, it was the low on the day. This is WTI crude futures 50.59, and it was ready to break 50, and then all of a sudden, boom, no news, no nothing, it bounces.
I think there is manipulation in the oil market. I think we're going to have to agree to disagree. I think OPEC could be on the other side because it knows they have the lower cost production, and if they keep the oil price below a certain amount and they keep the production instead of cutting back on the quota, they can take out, like you said, because they're aware of the higher production costs and the leverage on the balance sheets with these shale oil producers. I mean, basically the only reason shale oil even got any capital to begin with was because the oil price was around $100 a barrel and debt was cheap. And now we have oil price much lower. They've lowered their costs somewhat, but they're not generating any free cash flow. So if the oil price stays, if it goes to 40 again or it drops below 40, I mean, we're going to have big defaults on some of these oil producers. We're going to see a lot of bankruptcies fairly quickly. The hedges that were on, the reason there wasn't bankruptcies in the last like 5 or 6 months is a lot of these oil producers smartly, at least for the short amount of time that they did in the last like 18 months, they took out hedges at much higher oil prices when they took out the debt. So they drilled, but they had their oil price locked in at a higher price. But those hedges are coming off that were at $90, $100 a barrel oil in the next 6 to 12 months. Once those hedges are off, Dave, they're not going to be able to sell that oil at those prices. And the economics for shale oil just don't work at these levels or lower.
Well, I think you fell prey to the media disinformation about OPEC. First of all, China would take every drop of oil that OPEC's willing to sell them. And they got, $1.2 trillion in reserves, dollar reserves, that would enable them to do that. All right. The reason why the price of oil has tanked is it's a demand phenomenon. Demand has fallen off the cliff. And actually, I was talking to someone about this yesterday. A lot of those hedges for those shale oil companies have already rolled off, and we're probably going to start seeing bankruptcies in that sector, especially if the price of oil keeps heading lower, which I think it will. I mean, every other metric out there is showing us that the global economy is literally crashing. And so the price of oil crashing is because OPEC's juicing the supply? I don't think so. Where are they getting the oil from? Supposedly no one's letting Iran sell oil. Okay, so that's one source that's not there. And everyone knows that Saudi Arabia's oil fields are quickly being drained. So where's all this extra oil coming from?
Oh, I heard Iran sells a lot off the books.
Yeah, they do. They sell it to China and India.
Yeah, and there's a lot of people out there that think that Iran and Iraq could add, another 1 million or 2 million barrels per day of production in the next year or two. I've heard that going around to try to that could potentially cap prices, or that they've already started flooding the market with some of that. So I'm not sure.
It's a BS story. No, I'm sorry. Why would OPEC want lower oil prices? Are you kidding me? That would run against everything that OPEC has stood for as long as I've been alive, which is we want the highest dollar price we can get, except for the U.S. Saudi Arabia will sell it to the U.S. for a discount because you use your military to keep our royal family in power.
Yeah, I think they do want higher prices, but they also don't want to lose all their market share to the shale oil producers.
They're not losing their market share to the shale. Anyone who knows anything about this knows these shale fields have a very, very short life curve. The shale oil is almost all tapped out, from what my understanding is.
Yeah, there's projections that it may have already peaked.
They're not worried about oil shale. That's the narrative that you're buying into from the U.S. corrupt media.
Okay, well, let's talk about silver now. There's been record open interest in silver on the COMEX. Do you think that's because someone's standing on the long side, like the Chinese government or something like that, to take delivery of the metal? Why do you think the open interest is so large?
I don't think the Chinese government would mess around on the COMEX because, first of all, there wouldn't be anyone who would take a large long position with the anticipation of taking delivery of the physical, because everyone knows the COMEX doesn't have anywhere near the amount of metal in its vaults that it's reporting. And I think today's news from the U.S. Mint proves that. But no, I think the COMEX is not, first of all, it's not a physical metal exchange. It's a paper exchange. And the run-up in the open interest is J.P. Morgan and Citigroup shorting as much paper into the market as they can to keep the price down. And as long as they have enough access to physical silver, and don't forget J.P. Morgan is the custodian of the SLV trust, as long as J.P. Morgan and the other COMEX banks have enough access to physical silver to deliver into India and China, then it doesn't matter what the price is. They don't care, right? Because that's what the game is for them. And I also have a feeling, and I can't prove this, and no one could prove it, but I wouldn't be surprised if when this whole thing collapses and the dust settles, that it turns out these big bullion banks have been accumulating a lot of physical silver and gold, and they keep it in the new vaults that are over in Asia, in Singapore and Hong Kong.
Yeah, actually, I spoke with Greg Manarino a while ago about that. He worked on Wall Street, too, and he's still friends with a lot of floor traders, and what he was telling me is that a lot of the floor traders, they won't go on CNBC or Bloomberg and talk about how gold and silver are manipulated. They just look at the chart, and that's what they'll say in the interview. But he was like off the record with their trading profits, whatever they make. Sometimes they'll short the paper market really hardcore down and make a profit. And he said what they do is they buy the metal and they store it because they know that there's really that the supply-demand fundamentals are better and that the metal price should really be higher for physical.
Well, if you look at just the open interest represented by paper silver on the COMEX is close to 1 billion ounces, okay? There's only 800 million ounces of silver mined in a year. There's something like only reportedly something like 180 million ounces of silver being kept in COMEX vaults, of which less than 60 million of it is designated as being available for delivery. So how on earth could you possibly have a market that represents true economics if you've got $1 billion worth of paper silver outstanding that's been sold to buyers, and yet you've only got 60 million of physical underlying that could possibly be delivered? I mean, it's absurd.
Yeah, I mean, rationally, it should mean a shortage soon.
Is they create paper silver and they sell it into the market because they know the hedge funds that are taking the other side aren't going to take delivery. I mean, it's insane. Any other commodity market where you've had an imbalance in the amount of futures versus the amount of underlying physical on that exchange has been prosecuted by the CFTC. I mean, J.P. Morgan itself has been nailed for energy manipulation on the COMEX, or not the COMEX, but the NYMEX, which is now part of the CME. But they leave gold and silver alone.
Yeah, and Zero Hedge had a story on this about the open interest for gold and silver derivatives compared to the open interest for other commodities derivatives, and gold and silver have way more open interest for the derivatives market. I think, we're eventually going to have to get back to reality, which is supply and demand fundamentals. We're seeing a lot of evidence, whether it's record Indian silver demand, and I think I saw that they imported in the last 12 months 8,000 tons of silver, which is a record for them. The coin sales you mentioned, which are mint problems. We have to eventually have a market where there's going to be shortages and the price has to react, right? Because demand, to me, at least globally, not in the United States, because most people here in the West, besides the hardcore silver bugs or gold bugs, they don't buy metal because the chart doesn't look good. But people in other countries, they're buying. And then I look at the supply side, Dave, and I see, the base metal miners, the copper guys, they're in trouble. They're in a lot of trouble. I expect copper to. I agree with you on copper. I think I've said for a couple of years now. Copper is going to have a lot of problems because China has done a massive central planning with it. And, the primary gold and silver miners, especially the primary silver miners, Steve St. Angelo did a great article on this. He releases them, every month or two. And he shows how much money each ounce is, like the all-in production cost. And it looks like the primary silver miners, which is, I think, 30% of annual global silver supply, they're losing a couple dollars an ounce at least, and, they've been able to cut costs, but they're still losing enormous amounts of money producing each ounce of metal.
Well, I mean, you got to differentiate between the actual ongoing cash costs of pulling the metal out of the ground and the all-in cost accounting cost, which I guess it's now referred to as all-in sustaining cost. So, and that includes amortizing the amount of money that was spent up front developing the mine. But I think most of these miners that haven't shuttered their production are still able to generate cash flow, even though when you look at it versus the total cost of the mine, it's not economical. It allows them to generate cash flow in order to just keep the mines open and wait for the price of gold and silver to move higher eventually. Because there's also costs associated with mothballing a mine and then starting it back up.
Yeah, plus there's also government taxes too if the mine shuts down. There's also penalties for mines in certain countries.
Right, it's all part of the cost of either shuttering a mine or shuttering it and then starting it back up. So, I mean, the only reason I can think of that these mines haven't mothballed their operations is because they're still generating cash flow that allows them to sustain their operations for the time being.
I think another reason is also because some of the miners did hedge, so they have to deliver the metal, or the ones that took on debt, right? The ones that have debt, the banks probably told them they have to still deliver the metal or they're going to foreclose on the debt because they need the metal to deliver on either contracts or over-the-counter derivatives or things like that. That may be part of the reason.
Yeah, I think there's that going on too.
Yeah, I mean, I think the miners are running out of runway here. I think they have less than 12 months where the metal price has to go higher, or we're going to see a good amount of larger mines shut down. I know the costs, some of the miners, like First Majestic Silver, Pan American Silver, they have been able to cut their costs 30-40% last 18-24 months, but they're still losing pretty big amounts of money on their silver. I had Keith Neumeyer on. he said that they can cut their costs maybe down to $10 an ounce without shutting down a mine. But I don't know. I don't know, man. There's so many mines that have been brought online since 2008, 2009, and the feasibility studies for these mines, Dave, I don't know if you look at a lot of these miners too. I remember the feasibility studies were, 1,300 gold, 1,500 gold, $25, $30 silver, and I don't know how much cost they've been able to cut at some of these mines, but I guess they're still able to raise some debt. Keith Neumeyer told me that the investment banks call him every day trying to get him to take on debt, and he refuses. So I guess for some of the producers that are still going, they can still raise some capital, but the juniors, I don't know how much capital is available to them at this point.
I think it depends. It's on a case-by-case basis in terms of the juniors. I've spoken to a few juniors in the last couple of weeks, and I only look at and invest in and write about juniors that have feasible deposits and have cash available. And some of them are starting to run low on cash, but what they've told me is that they have investors who have indicated an unwillingness to keep them funded. So I think the juniors, it's a case-by-case basis. With the senior producers, again, I mean that's great if Neumeyer can get his cost down to $10 an ounce. That would probably just be his ongoing cash cost of pulling silver out of the ground and selling it. So yeah, I mean there's still a nice spread there that he can maintain, and it doesn't surprise me that Wall Street is just trying to get these companies to issue a lot of debt, because that's how Wall Street makes money.
Yeah, they've turned into almost all debt. We don't see a lot of equity issuances anymore. I mean, the IPO rules have, I guess, screwed that up. Where in the past there used to be a lot of companies that actually needed capital and they didn't want debt. They just wanted to sell shares and the public could buy shares. I guess we're seeing that now to a smaller extent with crowdfunding, where people can go to like Kickstarter or AngelList or some of these others and get some crowdfunding there. But the original, purpose of the stock market to a lot of extent was to raise money so Main Street businesses could grow, right, and create jobs, and that was prosperous for the United States. Maybe that was how Wall Street used to operate when you first started there, was they cared about funding real companies to create job growth and help the United States, and they saw themselves as a supporting role.
No, people didn't care about that. People cared about their year-end bonus, and that was it. No one looked at it as building America or funding America. We looked at it as, give us the next junk bond deal, we'll sell it, we'll trade it, we'll make money on it, give us our bonus.
Well, maybe before 1971 then. After 1971, when the debt started to explode, that probably mindset changed, because then debt became king after that. There was no limits on debt then, right?
Wall Street wasn't really much of an entity prior to the removal of the gold standard.
Well, my final question for you then has to do with Wall Street and your experience on there. I just started a new podcast called Welcome to Dystopia. It's kind of gallows humor with Eric Dubin about some of the corruption going on Wall Street and politicians and things like that. So I want to ask you about corruption on Wall Street. Do you think the corruption on Wall Street has increased a lot since you started there?
Well, I mean, I saw stories that would blow people's minds. I witnessed it firsthand. I saw outright corruption at all levels on Wall Street. But, I mean, back then there was at least some semblance of regulators doing their job and internal risk managers trying to do their job. We used to lie to the risk managers all the time. Well, fast forward to today, there's no rule of law. There isn't any part of the government that tries to enforce any part of the law other than the IRS. And the corruption has gotten way worse. I mean, it's, the things that were going on when I was there in the 90s are essentially a non-event compared to what's going on right now. I mean, I don't think there's one person on Wall Street who's not corrupt. I don't think there's one person in D.C. who's not corrupt. It's just the way of life now, and it's accepted.
Yeah, I've heard so many stories on and off the record, too, about corruption. I heard Porter Stansberry in his podcast. He was alleging for some stocks from some of the larger financial publications, like Barron's and stuff, that some of these guys get big payoffs from hedge fund managers in order to pump or dump in order to write a positive or negative article on the stock. And, we've heard people about seeking alpha articles. There's been controversies with hedge fund managers writing articles on there that don't disclose their positions. I mean, there's just so many examples. I read that Harry Markopoulos's book about how the Bernie Madoff scandal was mismanaged. I think, the regulators maybe a long time ago, they would have been more moral and maybe would have been able to stop it. But the system we have now, they're not attuned. They don't have the skills or the desire to stop it. I mean, the evidence Harry Markopoulos handed people an open shut case. He proved in 10 minutes that Bernie Madoff couldn't have produced those returns because the options market wasn't that large and he didn't have the trade tickets. So, I mean, almost anyone with a halfway decent financial education who wasn't a lawyer, right, or an accountant who knew about markets, they could have figured this out very quickly, that there was no mathematical way for Madoff to say he produced those returns. And yet here we have it, where a lot of people are saying, if we can put in more moral regulators, there's regulatory capture, we can fix things and we can get back to normal unlimited growth capitalism again.
That's a naive view of the world.
I agree, but it's what Marx wanted, though. Marx said that in his Utopia that he could get certain people to ignore, greed and immorality and things like that, and people would sacrifice for one another and things like that. But the people who believe in that, they're thinking with their heart, not with their head. They need to come down to Washington, D.C. or to Wall Street, Dave, and go live in New York City or D.C., and go meet a whole bunch of people around there for a number of years and talk with people and, have a couple drinks, and they'll open up and you'll hear the stories just like me and you have. I've heard the ones in D.C. You've heard the ones on Wall Street. I've heard some stories. I'm sure you've heard more of them on Wall Street than I have. But in D.C., I mean, I have so many stories of, regulators asleep, not doing their work, stealing, things like that, it's just ridiculous.
Yep, and like I said, it's gotten way worse over the last 10 years than it was when I was doing it. I mean, it just boggles the mind at how corrupt and criminal our whole system is.
And you brought up a great point before we started recording. You talked about the end of the collapse of empires and complex societies and things like that. There's plenty of examples of how this happened in Rome, how this happened with the British Empire. So, it even happened at many of the Chinese dynasties. If you want to go really far back, there's all these, great long empires and things like that. They just build up, and there's, rules and regulations and bureaucracies and high taxes and high inflation and just massive amounts of corruption throughout the system that just builds up because of there's no innovation and adaptation and things like that in the system anymore.
That's exactly right. And these people, when they get into a position of power, they realize that they have the ability to determine whether or not the law gets enforced, and they have the ability to steal from you and me, and no one's going to enforce the laws on them.
Do you think the TPP is just another of the latest examples then of that, where so many Americans are asleep? They're still talking about, I think, the Confederate flag and things like that. And in the meantime, the TPP gets passed, which is more corporate socialism and bailouts and things like that.
It's not
where they
corporate socialism. The TPP agreement completely usurps the Constitution of the United States. Any country that's a signatory to the TPP has effectively signed over their sovereignty to the tribunal of corporations who are established by the agreement, who determine what the law is, and the law. These are laws that override any law that's specific to any of the countries who are signatories.
That sounds like Agenda 21 and so many of these other types of laws that have been proposed or passed in the last couple decades.
I seriously hope that our system collapses before that TPP gets before the agreement is fully ratified by all the nations that are involved with it, because it's going to make life completely miserable for everyone.
Well, are you of the opinion then with me that one of the major reasons we haven't collapsed is because the BRICS, like China and Russia, they haven't decided to pull the plug yet, so they're either accumulating more physical gold or they're working on setting up the infrastructure for the next global financial system then before they decide to reset the system?
I've thought about all these issues for close to 15 years in terms of, when is China going to pull the plug on this country? And I don't know I think what they're trying to do is just let this country die out before they have to pull the plug, because the event, if they had to pull the plug, let's say they pulled the plug tomorrow, I can guarantee you the neocons running our system would start flinging nukes at them. And I think they know that.
Yeah, they wanted to do it to Putin. They've the neocons here in D.C., they write a lot of papers. They want first strike on Putin.
Right, exactly. That's part of the Wolfowitz doctrine, and it's part of a policy paper that Brzezinski was involved in, which is that they think that the people running the Department of Defense think the U.S. can win a first strike nuclear war. And I'm sure China knows that, and I'm sure that's part of the reason why China hasn't pulled the plug. But China's also has still some degree of economic dependence on us because they sell a lot of their goods to us into Europe. And I think they've been working for the better part of the last couple decades to try and diversify away from relying on exports to the U.S. And
yeah, they also...
It could very well be that once they've decided they have enough gold and they have enough other outlets in their region to make up for the loss of exports to the United States, that could be the point at which they pull the plug.
Yeah, they also they seem kind of like hedging their bets to a point. So, you know, they are accumulating lots of physical gold for whatever different reasons, and yet, you know, they're in the SDR now, or they're going to. So, I mean, that's playing the U.S.'s game and taking control of the IMF. Maybe they're planning on dismantling the IMF from the inside out then in the near future.
I have no idea. You know, all of this is just pure speculation. It's be interesting to see how it plays out.
Yeah, I mean, the Chinese philosophy, though, Dave, like, is normally to not drastically rock the boat. It's normally to do things in gradual steps. At least that's been the strategy the central planners in China have wanted to do with respect to China's presence globally. You know, internally, maybe they change things faster. Over there, they can listen to polls. They do a lot of polling, I heard. Internal Chinese citizens, and they change policies quickly. But the way they do business outside of China with foreigners is very different, and it's methodically in stages and steps and things like that. Well, Dave, in wrapping things up here, we've discussed a lot of dystopian types of things. So
we've been all over the map.
we did. I mean, welcome to Dystopia. There's so many crazy things going on right now that could crash everything tomorrow, and yet, you know, the markets just continue, most of them just continue to go up. You know, maybe they'll allow the markets to crash for 6 months or a year or something like that before they implement the next QE program and then just go for broke with the, you know, $200 billion a month or something.
You know, I don't know. I think it's a good question. I don't know if they're going to try and keep the system going with a lot more QE. I think that would be the only way that they'll be able to at some point. I honestly, especially after today, I honestly don't know how this thing's going to play out. I do think that we're looking at the final stages of the end game. But I said back in 2002 or 2003, when I figured out or had looked at what I thought was going on with the system, and I said, you know, these guys running our system are going to keep it going with printed money for as long as it takes for them to suck every last dime of middle class wealth out of the system and into their pockets. And right now, the only thing that's remaining is the pension assets, retirement assets.
Yeah, that's a good point. The 401ks and IRAs, I think there's, over $16 trillion estimated or something like that left in there?
That's estimated, but a lot of these pension funds are underfunded. So if your pension fund's underfunded by 50%, then really what you only have in there, let's just say across the board, every pension fund's underfunded by 50%, then you really only have $8 trillion of equity in there. So
we're also seeing articles come out, like in the personal finance, like Market Watch and others, where people are borrowing against those if they can, or people are paying the penalty and taking the money out just to survive. So I don't know if that $16 trillion is up to date anymore, because, you know, I've heard the stories even around Washington, D.C. area of people having to take money out of their 401ks and IRAs, pay the penalty just to survive and pay bills and things like that.
Yeah, I mean, the $16 trillion is probably the face nominal amount of pension assets, but on a net worth basis, the pension system's not worth $16 trillion.
But that is a big target for the people, that have been stealing the money to go after, though. That's like the last big target here besides doing quantitative easing programs, which is a wealth transfer and the currency swaps. God knows how many of those are going on behind the scenes. We've seen China announce currency swaps in the last 12 months or so, but they've been small, but I'm sure they're larger behind the scenes, but that's just China, I guess, transitioning to the next system. So, I mean, there's just so many crazy things out, and normally we don't hear about most of the stuff even in the press.
Well, we know the private equity funds and the guys running these private equity fund firms are selling everything that's not nailed down, and who do you think's buying it? It's pension money buying it.
Yeah, well, the pension funds bought at the top of the real estate market, right? And they bought the tech stocks at the top of the market. So I guess they're kind of being forced to. I heard some people at lunch over discussing they weren't financially savvy, and they were talking about how, like, why all the bond fund managers, like in the mutual fund bond funds, bought Puerto Rican debt. And I was like, well, no one in their right mind who was financially savvy would have chased that yield and bought that stuff, and yet I guess, people had benchmarks to beat and other stuff, so they bought that stuff.
Yeah, and it was also, a lot of that Puerto Rican debt is structured as muni paper, so it's got a tax-free component that appeals to high net worth individuals who have their trustworthy financial advisors selling them those bonds to get the yield. That's where a lot of it went.
Well, I worked in the financial advisor industry, and I would say most of the people who worked in the industry, at least the ones I talked to, were not very trustworthy. Most of them had really no knowledge of markets
idiots,
at all.
Yeah, no, I said that with.
Well, they wanted
with a big.
They wanted idiots.
Right.
I interviewed at other firms, and they told me I already knew too much. I should go work at one guy was like, dude, you know too much. I can't hire you. It's a sales job. You sell whatever piece of shit's on the paper, or I fire you.
Right. That's how it works.
Okay, Dave. Well, I really enjoyed this discussion. Please tell our listeners more about Investment Research Dynamics, your new podcast, Shadow of Truth, and your gold fund.
Sure. So my blog's Investment Research Dynamics, investmentresearchdynamics.com, and I try to post at least one or two new articles every day. It's usually something that's agitating me at the moment. Use it as a source of therapy. I also offer research. Right now I have home builder sector research that's geared towards people who want to short the market, and I've got some junior mining stock reports on there, and I'm getting ready to start on a fresh new batch of research reports. And the Shadow of Truth is a podcast show that I do with Rory Hall of the Daily Coin, and what we're trying to do is we bring on interview guests, hopefully who have a fairly high-profile name, and just chat with them about what's on their mind. And it's probably more of a less formalized setting than some of the other podcast shows that are out there. And then I also manage a small precious metals and mining stock fund. That's structured like a hedge fund investment, and we invest in physical gold and silver bullion and in mining stocks, which obviously for the last 4 years has been a terrible place to be. But I do think at some point, if we don't collapse before then, that we're going to see gold and silver do a U-turn here at some point. And again, I have no idea when. And I think that the reset of the gold and silver price will shock most people.
Yeah, we've had an artificially created bear market. I mean, the cyclical bear market in gold and silver is obviously it's been a lot of manipulation. The cartels capped the price, in my opinion. The investment banks have put out negative research reports. The tape is painted on the charts to a lot of extent. And there's a lot of evidence proving this with the guy from Nanex, Eric Hunsater, showing the exact same chart pattern, and you and so many other people showing evidence of that. But yeah, I do the podcast too for therapeutic reasons. Well, one of the many reasons besides that I get to meet cool guests like you and things like that. So yeah, it's really good to just put your thoughts out there and try to tell the truth, even though I think you have the quote on your website, right, from George Orwell about telling the truth.
It's on there somewhere.
Truth. Ron Paul has a new documentary, his first officially sanctioned one that's coming out. I think it's like Truth is Treason and the Empire of Lies. So that's basically along those lines right now.
Yeah, exactly.
Okay, great. Well, I look forward to speaking to you again in a few months, and thanks again for your time.
Likewise, Jason. Thanks for having me on.